messed up. Sorry.
Little campfire.
Yeah. All right. We good? Good to go? Go. Sweet. All right, everybody. Welcome back to another roundup edition of Forward Guidance. And we are recording live from Washington, D.C. We're out here at the Monetarium 2 conference put on by Reserve. Super excited to be here. It's myself, Quinn Thompson, and we pulled in Joseph Wang, Fed guy, to join us this week. So super excited to have you guys here, chatting here in Washington, D.C. What's going on, guys?
Not much. Excited to be here. Good weather. A lot of...
Absolutely. Great to meet you again, Quinn and Felix. It's great to be here.
Yeah. Quick show of hands. Who's listened to the Forward Guidance podcast before? Nice.
Before
today. Awesome. Cool to see that.
For everyone listening, there's thousands of hands raised.
Yeah. Thousands and thousands. You just hear the roars and claps.
The most beautiful.
The biggest crowd, guys.
Yeah, it's huge. Biggest.
Okay, so I want to start by talking about the FOMC meeting that just happened yesterday and get the high-level takeaways there. Somewhat interesting one, but also not interesting at the same time. But just going to go through a few data points here. I'm going to pull up my phone just because it was a dot plot summary of economic projections updated meeting. So there's a lot of data to get into and start to understand. So just looking at the dots here, in terms of their GDP projection, they actually downticked their projection for the March meeting for 2025 from 1.7 to 1.4%. So expecting lower growth. For the unemployment rate, for the March projection was 4.4, looking at 4.5% by the end of year. And PCE inflation, an increase again from 2.7 to 3, which comes off the back of another previous increase from the previous March meeting for the December one further. So this is an interesting situation. We're seeing growth being downticked in their forecast. We're seeing inflation ticking up higher, but at the same time, we actually didn't see any changes on their projections for Fed funds rate cutting. So most of the policy members, basically as you added them all together, when you look at the dot plots, we saw that the majority still ticked in for 2 cuts coming this year. What was interesting, however, is that yes, 10 of them had a 2 cuts by the end of the year, but there's an increase of FOMC members from 4 to 7 that were projecting no cuts by the end of this year. So lots to get into. Obviously, I didn't even mention the fact that they didn't cut rates, which shouldn't have been a surprise to anybody, but that's not what moves markets. What really moves it is obviously these dot plots and the press conference that came forth. So I want to pass it to you, Joseph, and just based on all that data, what was your read? What was your takeaways?
Well, first off, I think, like you mentioned, Felix, and that was a really good summary, what was most interesting to me was the dot plot forecast. It seems like the Fed is a bit more downbeat on the economy, revising down growth, but also seemed a little bit stagflationary, right? You're revising up inflation and you're revising up unemployment. So all in all, that seems like not good. Now, the Fed has always been saying for the past few months that they are basically just going to be late. So they're not cutting this time, and they kept their forecast from the last time. So what Powell has been telling us is that there's so many things happening in the economy. We have changes in policy, from changes in immigration policy, fiscal policy. Of course, we have changes in regulatory policy and trade policy as well. And he doesn't know what's going to happen, and so he's just going to wait to see what the data says. That's a little bit different than how he usually acts, where he tries to get ahead of it. Now remember, he cut 50 basis points right before the election last year, thinking that there was a recession, wanting to get ahead of it. But now he's committing to being late. So what that tells me is that he's really not going to do anything until we see the unemployment rate tick up. And it's been trending higher. Right now, the unemployment rate is 4.2%, but maybe, and Quinn will probably talk about this, but we see a lot of indicators in the labor market that it's softening. Powell has a different take. He seems to be very happy with 4.2%, describing it as full employment. But it seems like until that ticks higher, we're not going to get rate cuts.
Yeah, I thought it was interesting when you compared March to June on the dots. Basically, the only incremental change for 2025 was that 3 people went from 1 cut to no cut, and 1 person went from 2 cuts to 1 cut. So it was, that's hawkish, and I think one cut came out of 26, I believe, or 27, in the backdrop of that revised worse economic data. And he seemed like, for one, the nearest cut is not priced until September anyways. So being 3 months out, how much does this meeting really have near-term impact on markets? Not a ton. I did think it was interesting because I think we discussed this on last week's, how in that recent labor market labor report that the unemployment rate barely stuck at 4.2, so it was like 0.005%. Very easily could have been 4.3, but also that it stayed steady for the wrong reasons, meaning declining total number of employed and lower labor force number. And so someone did ask about the immigration issues, and he noted that this dynamic where you can have a more stable unemployment rate for the reasons of not growing labor, but actually shrinking labor force. And he basically acknowledged this as being okay. It will hold the unemployment rate lower for longer, and they will not look through that to infer a weaker labor market. So on many accounts, very hawkish. It's very clear they expect at least some meaningful uptick in inflation, and even September is, I don't know how guaranteed that is at this point off theirs. I think you really need to see market weakness for them to move.
Yeah, my take is just that it feels like, it's clear that Chair Powell is just trying to get to the finish line of his term in one piece, basically. Like, I think he would have preferred if he could have just skipped the whole press conference in general and just been like, all right, we're not doing anything, and we're just going to sit there and don't talk to me until at least 2026. But he's not in a situation where he can do that, so has to go up there. And the issue is that as monetary policy cannot not do anything. By doing nothing, it's still an intentional policy choice. So just by them sitting flat as they are right now, and that they hope to do so for quite a bit of time to continue, that's still an intentional policy decision, because the economy is dynamic and it's moving all the time. And as they sit, if you just think about like a classic Taylor rule type model, if we see them stay flat at the same time that the unemployment rate ticks higher, and to your point, we are very close to 4.3%. So you have that situation, and then you have these continuous downside surprises in the inflation print. We can keep holding out and wait for the tariff inflation to show up in the CPI data. And yes, maybe the big one's coming next print, but the fact of the matter is that core CPI month over month came in at 10 basis points. That's a huge miss. So there's a lot of services disinflation. We can talk about this some more, but there's a lot of fracturing underneath the surface of that unemployment rate in terms of the labor market. So it just feels, and I'm curious both of your thoughts on this, that by just staying flat, it's still creating an even more restrictive monetary policy stance, even though their intention is just to not do anything that goes either hawkish or dovish, but by doing nothing, they're actually being hawkish.
Yeah, so as inflation comes down, real rates go higher, right? So I think one of the points that he mentioned was that if you were backward looking at the data, you'd probably be cutting by now. Like you mentioned, labor market is softening. It could have been 4.3%. If you look at continuing employment claims, that continues to rise, right? That means the stock of the unemployed people are rising. So if you lose your job, it's harder and harder to find a new one. Now, this past week, there was also a very interesting story in the Wall Street Journal showing how new grads are having a lot of trouble finding a new job. So the unemployment rate for young people is also rising. So definitely clear weakening in the labor market. Now, inflation has been coming in softer as well. Not just CPI, like you mentioned, Phoenix, but the Fed's goal. Headline PCE came in at 2.1% year over year in April. 2.1%, 2%, that's pretty close to me, right? So the Fed is not acting in response to this data because it's telling us, like you mentioned, that we have inflation from tariffs coming down the pipeline. So in the press conference, what really struck me was that Chair Powell was like, the professional forecasters, basically the experts are telling me that inflation is coming down the pipeline from tariffs and so forth. And that's all super reasonable, but it's also not consistent with how he's behaved the past few years, right? The past few years, well, let's listen to the forecasters. That got us nowhere. And so it's like, okay, let's listen to the data. Let's be data dependent. Okay, let's do that. Now that the data is like, we should cut, it's like, let's listen to the forecasters now, right? So he just wants to be hawkish.
Yeah.
He's finding reasons to be hawkish. So, yeah.
It's pretty funny. I don't know which press member asked Powell about this, but they brought up that point that, okay, well, you were saying that you're data dependent. The data right now is saying that you should probably be cutting.
Kind of went on tilt.
Yeah, he got caught up in his words. It's just like, well, now you're saying, well, we're looking into the future and there's inflation coming. But to your point, like that's going against everything. So, I mean, yeah, it's just the Fed wants to be hawkish and, we can complain and piece apart, but that's just what they want to do. They just want to get to the finish line of 2026 and they'll find a reason to do that. And, we can talk a bit about the macroeconomic impact of that. But yeah, it just seems to be the way it is.
I think the case to cut is also not that, like one of Powell's points was, he said something along lines, which he almost never comments on in the market, but so he kind of was, it was one of the more interesting pressers I've found in recent few, but he mentioned something along the lines of the current market conditions and how things are trading or something of that nature do not reflect very restrictive or extremely restrictive or some language, which he's kind of got a point. I mean, if stocks are back at all-time highs, valuations where they're at, like, and I think there is some anchoring bias for all market participants where it's like, in the grand scheme of things, 4.2, if you look back many years in history, is pretty low. It's just the underlying nuances is, and the weakening of, the lower middle income class. So it's a tough situation. I can't say he's like that wrong though to not move.
Yeah, that's fair. I think too, like an interesting situation right now is just how noisy all this economic data is right now. Either it's, we had retail sales last week and the seasonal adjustments were just pretty significant. And we had like, the control group surprised the upside and then everything else surprised at the downside. We have, the NFP has been revised every month quite significantly. So yeah, it's a tough situation. Like, Joseph, I'm curious on your thoughts. Just what do you think are the best reads on the actual state of the economy right now? Because it just feels like every data point has so much noise to it.
I think that's really hard because a lot of people are behaving differently in response to the macro shocks we're having, right? So we had widely telegraphed tariffs. Everyone was kind of importing a lot beforehand. Maybe consumers were also stocking up beforehand. And so then we had the big tariffs. Everyone was scared. Trump pivoted. Now we have some 90-day pause, so maybe people are restocking, or maybe they stocked too much and now they'd run down their inventory. So I think the data is going to be really noisy, and I don't really know how to read it the past few months.
Mm-hmm.
So
yeah, totally. Okay, so something else that's happening, I think it's next week, is that we got news that the Fed is planning to have a meeting about the supplemental leverage ratio, which Quinn, you talked about earlier in your panel today here at the conference, but that's been an interesting one because it feels like this carrot that's been dangling over the market for like the past 6 months, where there's talk, every time it feels like on the Treasury side as well, Scott Bessent's talking about, we want to deregulate the banks, we want to alleviate capital ratios and risk-based capital ratios as well. So the Fed have announced that they're planning to have a meeting next week where they're looking at actually implementing some sort of either SLR exemption for Treasuries or just a meaningful loosening of those SLR levels. So fortunately, we got Joseph here, who's been at the New York Fed, worked in that world very deeply. So I'd just be curious if you could just explain to us that whole dynamic. Why are they pursuing this deregulation approach, and how does it mechanically work into the market, what they're talking about?
Sure. So just taking a step back, in 2008, we had a huge crisis in the financial sector, and that hurt a lot of people. And so the regulators decided we can't let this happen again. So we got to regulate banks in a big way. And so they passed all these regulations, Dodd-Frank, and also internationally there's Basel III. And what these regulations do is, at the end of the day, impose a whole bunch of costs on banks based on the size and composition of their balance sheet. So for example, you have risk-weighted assets where, let's say that if you hold a riskier corporate loan, you have to hold more capital against that. Capital for a bank is a liability, so it's like a cost. So that makes sense, right? If you hold, and it's intended to absorb losses. So that makes sense. If you are making a really risky loan, you should have lots of capital against it. In case that loan goes sour, the capital can absorb the losses rather than the depositors. That makes sense. And also, let's say that we don't want banks to ever have like a liquidity run, right? So that's kind of what happened in 2008. So we're going to mandate them to hold all sorts of liquid assets, tons of reserves, and also make sure that their liability structure is more sound. So make sure they're not borrowing too much overnight, make sure they have, let's say, longer dated liabilities that can't be run on. So their depositors can't run as easily. Also, we do stuff like stress tests and so forth. And to cap it all off, just to make sure that just in case we got anything wrong, because as we know from the financial crisis in 2008, sometimes things that are AAA are not actually AAA. So they added something that was a backstop, and this is which is basically a leverage ratio where banks have to hold capital against an asset regardless of its riskiness. So it's basically completely based on size. So for example, in this case, in the leverage ratio, you would have to hold the same amount of capital against treasuries as you would a risky corporate loan. So this SLR right now on the bank holding company holding level, it's about 5%. On the bank level, it's about 6% for the largest banks. And this has been a real hindrance for banks that traffic in assets that are very safe, like treasuries, because it imposes costs on trading these assets that don't really make sense because they're liquid and credit risk free. And it's been widely thought of that raising the costs of banks trafficking these riskless assets it has been harming the markets. And so we saw that in 2020 when we had a crash in the treasury market, and the regulators, in response, suspended the SLR for a year, and that seemed to help a little bit. And now, as the treasury market continues to grow because we continue to issue a lot of debt, it's becoming more of a highlight for the regulators. They don't want the market to break, and they're also thinking that maybe if we were to decrease the cost of banks in holding these treasuries, maybe they would buy more. Maybe that would put downward pressure on interest rates. So that seems to be the impetus for trying to change these regulatory things. And they've been talking about it a lot, and now they're finally having some action, which was announced. And it could be through just toggling the ratio, it could be exempting reserves or something like that, but that's something they'll try to figure out. So maybe that will have some relief for the market.
Yeah, it feels like there's still a bit of debate now on the impact of what this will do, and there's a lot of different interesting cross currents when you just look at the composition of all the different decisions or policies that are being made right now. And so, okay, we have a treasury that is issuing a lot more bills than historical standards. They are avoiding at all costs increasing the proportion of coupon issuance that they're providing to the market. That's been something that, people starting to call it like activist treasury issuance or Yellenomics. But it's clear that Scott Bessent's continuing that. Now we have forward guidance in the quarterly refunding announcements, basically, where they mention that there's no plans to increase the amount of coupon issuance. So it's all going to go towards the bill side of issuance. So you have that dynamic happening right now. You have what's going on in terms of the debt ceiling situation, where they cannot issue more debt. So we go into this situation of extraordinary measures where they do a lot of different tweaks to be able to continue to issue debt. And then once that's complete, they start to run down the Treasury General account. And that X date gets to around us early August right now, where if they do not come to some sort of resolution on increasing the debt ceiling, we would theoretically default. Obviously, there's further protections against that, but that's the theory. So you have that situation, and so what happens is that the Treasury General account gets drawn down, and then as soon as the debt ceiling gets resolved, they got to rebuild it back up to basically a level where, I forget the exact number, but effectively they want to be able to keep about a week's worth of Treasury operations in the TGA for whatever reason. So that gets us to about $800 billion right now. So I think you had the numbers of where are we at in terms of right now the TGA versus the RRP, because this is the dynamic, right, is that you have a lot of bill issuance that needs to be rebuilt, and we need to think about where does those flows come from. And that really, I'll circle this back onto the SLR thing, but do you want to just explain a little bit on terms of where we're at in terms of the TGA dynamics and where that got funded last time? Because you have some interesting analysis around that.
Yeah, so this recent tax payment date that actually hit in the June quarterly this week refilled the TGA from like 250, 220. It got down to back up to around 450, I think 470, and then I think there's about 150 or so in the RRP. So that'll all get drained. The X date in August is when the TGA basically is zero, and depending on if it's early July or late July, whenever that is, will dictate how much of a refill is needed. But it's from here, it's however much they refill, it's going to get drawn down in the meantime. But the interesting thing is that in 2023, the most recent analog where this occurred, reaching the debt ceiling and refilling the TGA, they had a massive amount in the RRP to buffer this bills issuance. So I believe when they refilled the TGA from about June 23 to October 23 is about the time it took, so like 5 months or 4 or 5 months. They also drained the reverse repo program by about $1 trillion in that time period to bolster the market. And in this go round, they have about 150 there, and there's also about 2x the nominal coupon issuance number that needs to be hit. So I think Bessent is well aware of this, and the last 2 times of these TGA refills, long duration bond yields rose over 150 basis points, and so they're trying to pull out all the stops, including SLR, to bolster that. But the tough thing because I think most of the analysis I've seen around the SLR from the banks and stuff is evaluates it in the context of what occurred during COVID, when the last time they made this exemption. And that's a difficult comparison because at the time, we were potentially in deflation for that short amount of time, and the Fed had forward guidance stating there's no cuts in the foreseeable future and inflation was transitory, et cetera. So we saw the repercussions of that mentality result in the 2023 banking crisis, where everyone was stuffed to the gills with duration, Treasury yields blew out, and all of these balance sheets were insolvent and needed to be essentially, bailed out or massaged in a way by the Fed. So I think there's probably PTSD on the banking side that restricts them, in addition to a less rosy view on yields that limits how effective the SLR is. I think it'll do something, but
yeah, I feel like when you put that all together, that's why there's a lot of debate around, okay, well, why are we doing this SLR exemption thing? Because it's not like these banks are actually they're not actually constrained by SLR right now. They're more so, I believe, correct me if I'm wrong, Joseph, but they're more so constrained by the risk weighted at ratios as opposed to the supplementary leverage ratio. But the way I think about it is it feels like more so they're trying to, I remember when we introduced the RRP facility, ramped it up and started to increase the award rate, they talked about greasing the runway. And it feels like they're trying to grease the runway right now for when this huge rebuild comes forth. So you see this dynamic of trying to get these deregulations to happen. And then furthermore, we're starting to see them try to really pass this Genius Act bill. That's an interesting one because the fastest growing buyers of Treasury debt right now are stablecoins, like Tether. They're the 9th largest holding, and one of the fastest increasing right now. So it feels to me like they're trying to prepare a lot of these to grease it for when we get to this August date to basically effectively rebuild the TGA. That's where it feels like. And maybe we can talk a little bit about how we think that impacts the liquidity outlook and generally macro overall. Because to your point, you think that yes, these are factors that they can start to execute on, but regardless, it looks like long bond yields would likely increase. I'm curious how you both think about what that would look like, because obviously we've hit that 5% level a couple times on the long bond in the last couple months, and the first time we hit it in the last couple of months was around Liberation Day and that whole impact, and that's where we started to see a lot of seizing up in the Treasury market a little bit. We've hit it a couple times since, and it hasn't been as sketchy, but it really feels like the 30-year especially getting above that 5% level is a level that nobody's really interested in happening. So I'm curious how you both think about the possibility of us going above that 5% level.
So like you mentioned, the 30-year has been touching 5% for some time. It really doesn't seem like it wants to go lower. I'd also take a step back and note that this is a global issue, right? The Japanese 40-year was in the news for some time. It just keeps going higher and higher. But similarly, when we think about the Japanese 40-year, it's gone down a lot because what they did was they did Yellonomics, right? So they changed the composition of issuance by issuing fewer longer dated stuff and more shorter dated stuff. And so when we think about longer dated yields, we have to remember that there's a whole lot of tricks in the bag to keep it lower. One of them is just to pull a Yellonomics activist treasury issuance, as Stephen Moran would say. So that's possible, but I think the trend, absent all this, would be to have higher yields. But these are things that are carefully managed. They can continue to issue more bills, or they could say, because of SLR, just go and force the banks to buy a lot more treasuries. And now, this is not something that they're talking about at all. But if you take a step back through history, whenever a government has too much debt, this is not the first time this has ever happened before. This happens all the time. All governments actually run into these problems, and one of the most common solutions is to have your commercial banks foot the bill. And so maybe not today, but maybe next year, a couple years forward, maybe that plays a bigger role, and that puts somewhat of a soft ceiling on yields. But until that happens, well, actually, in order to precipitate that, we probably have to have the long bond continue to go higher.
Yeah, I'm of the belief that we do break out of the 5%. I think it's like a big 3-year, ascending triangle wedge type thing. And I think we might have skirted that move because of the delays in the bill, because really the catalyst is when the refill starts. But to me, if you're a bank, Jamie Dimon's talked about this. A lot of other bank CEOs have talked about this dynamic in the Treasury market, and fool me once, shame on you, fool me twice kind of thing. So I think we're actually headed for a meaningful breakout in the 30-year, and it, in my opinion, could be upwards of 100 basis points to like over 6% later this year. And you just, you get the momentum, guys. You get everybody on that trade once it starts going, and this debt burden problem that has to come post-bill passing. So for me, the real catalyst is when the bill comes, and we'll see what. I don't think it's good for risk, and I particularly don't think that it will be good when people recognize this dynamic of risk down, yields up, and how you're kind of stuck in that case, because Fed cuts ultimately make things worse.
An interesting thing I'm going to throw into the mix here to think about too is the situation that we're going to have to start to think a lot more about, which is what happens in 2026 and who replaces Chair Powell, because that is going to very much start to be considered into the market, especially something like the 2-year yield is going to have to start to discount that. So we need to start thinking about what will it look like when we get into this regime where if we see a long bond sell-off at the same time that we start to get guidance on who's going to replace Powell, and it's probably going to be a dove, a very, very dovish, the doviest dove you've ever seen. We could, and you're starting to see this in the SOFR curve start to price it too and start to consider it, is what happens in 2026 when we get a super dovish chair that cuts rates by 200 bips, regardless of where we are in the economy, and how does that get digested? Because there's a lot of different cross currents there. If you start to weight all your issuance towards bills, those are very sensitive to the Fed funds rate as opposed to the long end. So you can cut your interest expense by a ton, but by doing so, you're probably going to also lose the long end. And so I'm curious on both of your thoughts on how do you start to think about this fact of what could happen if, let's just use this theoretical of 200 bips cutting the Fed funds, regardless of where we are in the economy. How does the market digest that situation and deal with it?
The president gave an interview last week, and he was like, Chair Powell, he's like a stupid person. Maybe I'll just appoint myself. So, hey, we'll just skip the middleman. We'll just have President Trump be chair. After all, as he's mentioned before, it's like the easiest job ever. You show up in the office once a month, you flip a coin, and then everyone thinks you're God. So it's such an easy thing to do. So,
he is a rates guy, he says. I'm a rates guy. Yeah.
So you're right. I think that whoever President Trump appoints, it's going to be someone who's pretty dovish. Now, to be clear, some of the people he's been floating, like Kevin Walsh, as I understand, he wanted to hike rates after the Lehman Brothers went down. So he's not historically known to be a dove, but we can evolve in our thinking. Other people, I think whoever he chooses is probably going to have to profess some sort of dovish inclination. So yeah, we definitely are going to get a dovish Fed chair. If he were to really cut rates a lot, I think what I would be looking at is the dollar, because I think that could severely depreciate the dollar. And that would be really bad for all dollar assets. When it comes to longer dated bonds, yes, I definitely agree. Like longer dated yields going higher, that's going to be really bad for the bond market. But again, like I mentioned before, there are so many tools for the government to manage this. At the end of the day, this is just a giant database. These are just numbers in a computer, and the government controls that computer. So they can make it so that their buyers, be it the Fed at the very last, Chair Trump would just go and buy long end or something like that. I'm not saying this will happen, but these are things that they can do to make sure the long end doesn't get out of control. What they have less control of is the currency. And so that's what I would place my biggest bet on.
Yeah, I tend to agree. I mean, you wonder how much of the psychological benefit of that easing would be priced in ahead of time as well, right? Like, I think, as Joseph mentioned, you would see the moves in the dollar and probably some of these like gold or safe haven assets, and as well as the bond market, really, because if you're a 10, 20, 30-year long duration bond investor, the next year kind of doesn't matter too much relative to what's out there. So that would be a dramatic steepener, and in many ways maybe even go against his actual, like, the market effects actually might go against his intentions in that sense. And what I also would point out just on the interest expenses, the weighted average maturity of or interest expense of U.S. debt right now, I think, is like 3.5. It's under 4. So even if the guy comes in and cuts 100 from here, it actually doesn't really lower interest expense all that much immediately.
Yeah, you have to go way more.
Yeah. So I don't know. I'm not buying too much or incorporating the sort of hysteria around this shadow Fed too much yet, because I think there's a lot of unknowns. But I do think as we get into like Q4, it starts to become relevant when you're sub 6 months out.
Yeah.
Putting everything together, like you mentioned, so we have that stablecoin stuff, Genius Act, stablecoins buying more bills, maybe they'll issue more bills, maybe we'll have a Fed that cuts rates. You add that together, you end up with short rates lower and the government borrowing more in the shorter dated sector. So that would be helpful for interest expense. I don't know if that's what they actually do, but that's a potential contours for a plan.
Yeah, definitely stimulative in inflation, pro-growth, pro-inflation, pro-nominal growth, pro-inflation.
Another theme to all of this is the theme of fiscal dominance, which is a word that gets thrown out, I think, a little too easily versus what could really happen. But it's been interesting to see what's going on the fiscal side right now, where we've started to see, it's been led by Senator Ted Cruz, about removing interest on reserve balances, which is something that they implemented in 2008. And, effectively, the banks can park a bunch of their reserves at the Fed and earn a pretty good yield. And that yield is basically, we are subsidizing effectively bank revenues and profits from printing money. That's effectively what happens. So that's the discussion at hand right now. But it's a really interesting situation because we implement monetary policy very differently from back in 2008, where the interest on reserve balances is a very important factor for protecting that range of the Fed funds range. So, Joseph, I would love for you to just explain, like, obviously this is just a theoretical right now, and it's just talk at the Hill right now, but like, what would be the impact of something like that if we actually removed interest on reserve balances, and what would happen?
So, like you mentioned, we started paying interest on reserve balances after the great financial crisis. Before that, reserves had no interest. So we started paying because at that time, the Fed was doing QE, flooding the system with reserves, and banks were stuck with this asset that had zero yield. And they were also in bad shape. So if we gave them a little bit of interest, that would support their income, and they wouldn't have to be basically taxed by this. And the Fed also uses to control interest rates. Now, there's a lot of ways to do this. If we just went cold turkey and turned off IOR, I think it'd be tremendously disruptive. Now think about it. You're like a bank, JP Morgan. You have a few $100 billion worth of deposits at the Fed that suddenly yield nothing. What are you going to do? First thing, you're going to put a lot in the reverse repo facility. You're going to max that out. and then you're going to go out and you're going to say buy bills, lend in repo, and so forth, and that's going to put downward pressure on all short-term interest rates, and the federal funds market would disappear because there's no point for that. So it'll be chaotic. So it's not going to be how it's done. They're going to have to design it in a certain way. So right now, banks hold about $3 trillion in reserves. So at current interest rates, they're getting, let's say, $120 billion worth of interest income from the government. The government really doesn't need to be paying all that to them. So there's definitely some scope to try to make it so that, maybe it's less. So I think this is something that Ted Cruz has a point on. And you don't actually need Congress to do this. You just kind of need the Fed to do this, or a new Fed chair. So this is something the Fed has a right to do. They don't need Congress to do that with.
Interesting. Yeah, I bring that up around this framing of fiscal dominance because these are ideas that are starting to feel like that, because that's effectively, it feels like the fiscal side of things is obviously they're always creating the guardrails around monetary policy through congressional approval, but it feels like this is getting a lot more heavy-handed, where it's like, hey, this is what we're doing. We're trying to narrow the fiscal deficit, and I'm just curious how you both think about that situation of if we see this trend continue of these decisions being made, and then the Fed having to react in these different ways in terms of how they actually implement monetary policy. It feels like that's a very different theme from the last 15 years.
I think fiscal dominance has been with us for the last, really since, dating back to COVID, but also the examples in 2022 and in 2023, the March banking crisis, the real yield scare in October of 23, and in these cases where they've had to do things to, really the reason they've had to step into the markets in these cases is because of the pressure on the long-term bond market. The worst case thus far or recent case has been the Bank of England gilt crisis in October 23, or October 22, but you've also had the Japanese bond market problems and Europe broadly. So it's kind of where everybody's headed, and it's really like playing the game of fiat pairs is almost like who's going to get in a worse situation quicker, and the cadencing. The reason the US dollar is so at risk in all of this is because of the extreme, it's not that Japan's fiscal situation is great, or Europe's or France's is in anywhere decent of a spot. It's simply because of the concentration of US asset holdings by foreigners, and what I was saying earlier is this blow off top in US dominance and exceptionalism earlier this year that culminated in the largest concentrations in asset flows into US dollar assets in decades. So that's the risk really here for the dollar is that rewinds as a result of whatever types of confidence crises that may arise. But immigration and tariffs are definitely helping accelerate it.
Yeah. Okay, I want to zoom out a little bit and start to incorporate some of the global impacts of both capital flows and obviously the geopolitical situation happening in the Middle East right now, and really just focus on some of the market impacts, because I don't pretend to have any sort of meaningful edge in predicting these geopolitical outcomes right now. But what we do know is that what's developing in the Middle East is increasing tail risk for oil, which would increase tail risk for inflation, which would increase tail risk for long bond yields. So you have that situation, and then also this situation around global capital flows. And to your point about the blow off top in American exceptionalism that we feel sort of happened in January, a lot of that is also tied to tariffs and balance of payments resolution, whether that be through tariffs or through basically capital controls on the other side. There's some interesting tidbits in the big beautiful bill right now that are effectively either taxing remittances or foreign withholding taxes on U.S. assets. Those are capital controls that are looking to decrease the flow of funds into U.S. assets. So based on those two dynamics, I'm just curious where you guys are at in this thesis of American exceptionalism, because just to think about the market in the last couple of months, coming out of Liberation Day, it felt like Europe was outperforming on their equities. A lot of different, we saw these huge moves, and so much of this has been currency related, but the last couple weeks, we've seen the US market outperform a little bit. And so I'm just curious how you both are thinking about these dynamics of an increasing oil price from terrorists in the Middle East, these balance of payment flows, and how that all comes together into thinking about how much do I weight U.S. domestic assets versus the rest of the world?
Well, just looking past the past few months, what we've seen is that, before what happened in the Middle East, there was some loss of the shininess of U.S. exceptionalism. We saw that after Liberation Day, dollar sold off, Treasury sold off, U.S. equity sold off, and then you have tremendous outperformance in, say, European markets. And the theme then was that, the U.S., we are kind of overexposed. So Quinn had a great presentation this morning talking about how foreigners are just super, super exposed to dollar assets. And it seems like that was reversing a bit, where foreigners were moving back home a little bit. Now, since what's happened in the Middle East, I think, well, first off, that's going to affect regions differently, right? For example, in Europe, they're much more dependent upon imported energy than the US, who is actually the largest energy producer in the world. And so what's been happening since then is that US assets seem to be doing a bit better than European assets, and the dollar seems to be getting a tiny, tiny bit in strength. But my read is that the dollar safe haven bid is not really strong. I would have thought that would be stronger given this prospect of significant escalation in the Middle East. So I think this move away from US exceptionalism, or as some would say, the EMification of the US, is a structural theme. It's not going to happen in one day. It's going to be 2 steps forward, 1 step back. So that glimpse of it we saw on Liberation Day, I think we'll see it again, and I think we'll see it more often, but it's not just going to happen overnight. We have an entire framework that's been built up over decades, and it's just not going to disappear so suddenly.
Yeah, I think it's always, there's always like a shot across the bow move and then preceding a bigger thing, because the majority of people, operating in the past regime and environment, and 8 times out of 10, they're rewarded for that, buying the dip or what have you, and regime shifts don't come along too often. But in this case, I agree with Joseph that the sort of decline of the dollar is there's many forces influencing that, and I think my view in the more immediate term is that there's record short positioning in the dollar. Every bank research report I get is their highest conviction trade for the next 6 months is short dollar, and in the futures market it's the same, and then you kind of mix in some of these geopolitical things where if oil price does remain elevated, even though I don't think that's so much the case because Trump's so focused on it, he literally dedicated his first international visit to the price of oil. So I'm not factoring that too much into my projection, but I do see sort of a rinse of that positioning. When everybody thinks this outcome's going to happen, it doesn't always happen linearly. And ultimately, though, if there is a larger decline in U.S. assets as a result of this, and we just sat here and talked about how foreigners are loaded up to the gills on exposure, they're taking nominal wealth hits as well, just alongside everybody else. And so, yes, there's a dynamic of repatriation and reallocation away from the U.S., but if you're doing that from a minus 10 or minus 20% basis, on top of if the currency gets hit and stocks are down 10 or 15 and currency's down 5, that just adds to it. So it's not like they're flourishing and have all this money to bring back home in a good way. So I think you could maybe just see a situation where those assets fall less because there's less concentration, less holdings. And maybe on the other side of it, they outperform because people see this trend that's coming, and the valuation difference is still there. But could be the next leg is just, we haven't had the degrossing yet. We haven't had the deleveraging yet. The musical chairs are still being swapped around. And if we do get a broader degrossing event, then probably nothing, even maybe gold, is not safe in some of those cases.
It's always so tempting when we get into this type of conversation of talking about the assets of the reserve currency, which is the US dollar in present day. And it becomes very tempting to start to think about, these are a lot of signs that lead to the end of reserve currency statuses often. Like, this morning we had a really great presentation from Mark Dinner, who worked at Bridgewater, and he's one of the heads of Ray Dalio's investment research team. And he walked us through, looking at different regimes of previous reserve currencies and how they fail in the process for them. And it's really compelling stuff. So I myself find it very difficult to try to stay level-headed, but then also see a lot of these signs. And it's like, we're ticking all the boxes right now, heading towards this direction of reserve currency change. But at the same time, that's been a losing trade for many, many years now. And there's been people talking about unsustainable fiscal deficits for my entire life. And we've gone through many phases of that. So I'm just, curious on a high level how you both appropriately discount those two possibilities, because it feels irresponsible to not consider change in reserve currencies, because the history shows that they do change in the way that we're seeing right now. But at the same time, that's, it's like, what's the trade on that, So I'm just curious, like, how do you both balance those possibilities?
I think that, so people have been talking about dollar losing reserve status for some time. It doesn't seem to be happening. But some assets have been benefiting from that gradually over time. Gold, for example, right? Gold just keeps going higher and higher. So dollar is still reserve currency, but gold is still benefiting. So I think that will probably continue. I think that we are at a point where, I won't say reserve currency status being lost, but being weakened and dollar being depreciated. And that seems so obvious to me because there's so many factors going for it. Like you mentioned, we got the very large fiscal deficit, but more importantly, we are doing so many things that are just antagonizing people, foreigners, to discouraging them to hold our assets, right? Whether it to be perceived to be behaving erratically, whether it to be, for example, basically having trade policies that might involve some degree of coercion and so forth. And I think there's a sense that the administration doesn't actually want to have the reserve currency because they think that there are people in there that think that the burden that comes with being a reserve currency outweighs the benefits. And so for this country to be able to have a stronger manufacturing export sector, we need to have a weaker dollar. And I think some perceive that reserve currency status is an impediment to having a weaker dollar. So, I mean, if you don't really want to have a reserve currency, a lot of people do. And maybe that will just go to other places who actually do, and that's going to take time. But we're definitely doing all the right things to move towards that.
Yeah, it's such a long moving trend. I think you're better suited playing other things, right, in that case, because at the end of the day, if you're playing fiat pairs, that's why you plot gold versus every currency, and it's a kind of straight line up with very few dips. Global bond yields is a similar chart over a longer time horizon. Eventually, this would result in more commodity price appreciation, and with these things, you get geopolitical issues rising, which put scarcity concerns on your supply chains and commodity resources. So I think there's a lot of other ways you play it, but it is interesting because for many years, every fund or investor, asset allocator, in the U.S. but also abroad, given how much unhedged dollar exposure there are from foreign investors, have just assumed the dollar to be this kind of rock and stable currency and the best of the dirty shirts. But the reflexivity of if that changes and how many people need to sort of scrap their plans and rethink creates flows that beget flows. And it's a very inflationary outcome for us. And it creates these pockets of different circumstances where we've benefited from importing deflation via stronger currency. And if you go to like a situation where your currency is depreciating 5% year over year for 3 years or something, that means in a time where we're importing a massive trade imbalance, that's very inflationary and has more ramifications.
Yeah. All right, so just to wrap this up here, just want to talk a little bit about how to navigate from a portfolio standpoint, everything we just talked about, because to me it just feels like almost every asset class has some sort of landmine associated with it right now. Whether that's, okay, I'm going to go own U.S. equities, but oh wait, the flows are going to go in the opposite direction for the next few years. Yes, we will get these bounces of changes, but overall it's likely going in that direction. Bond yields are looking like they're going to go higher. Rest of world equity is interesting, but then again, to your point, Joseph, geopolitical tensions are much greater tail risk for those countries. There's also, way too much regulatory red tape in Europe to be interested with anything technology related there, even though they may get those positive flows. To me, it sort of feels like you're left with gold and Bitcoin. Gold, obviously, we talked a bit about already, and it seems like a really solid bet. Bitcoin too, but it also has that correlation to risk off. So if we do go into these sort of degrossing moments, like you talked about, Quinn, it's going to get hit with that. So you got to be managing your risk really effectively. But aside from that, I see holes in everything else. I'm curious what you guys think.
Yeah, I hate the risk reward for almost every asset, and I think like the most money to be made over the next 12 months is probably on the short side of most assets. And I guess, if you're in cash, you're long the dollar, and even that is probably not that safe. So I think, inflation protected securities, bonds, tips, like things like that. I think, and playing the short side, I do think like if you denominate your currency, if you think about your portfolio and you're like, I'm dollar based, but well, maybe I want to be gold based, so I'm always long gold, or changing that up is probably prudent, or playing currencies more often than you would to protect your purchasing power in that way. So I think there's more games to be played there. But yeah, I mean, even Bitcoin, you really have to wait till the intervention occurs before the positive read-throughs of liquidity make it attractive from here. Because Bitcoin is the liquidity release valve, and if Powell's committing to being 3 to 6 months delayed on cutting, like that's not an attractive setup either. So I think like short bonds, short equities almost, and then eventually when the weakness does materialize, they will probably cut more than they currently expect, and they will turn from hawkish to dovish, and in that case, I guess the 2-year note does really well. But yeah, there's a lot of landmines out there. That's a good way to put it.
Yeah, so I agree with you guys. I think there's a lot of things happening outside. So for my subscribers, I have a market view portfolio to help people think through about how to position. So in that portfolio, there's only 2 things. It's cash and gold. And hopefully, as some of these riskier things materialize, and if the currency continues to decline, like I think it will, I think there'll be good buying opportunities in the coming months. So that's how I'm thinking about it now.
Nice.
And
right on.
Personally, I like the short side too.
Yeah, sounds good. All right, well, yeah, we'll wrap it up there. Thanks for joining. Joseph, always great to have you on as well. Appreciate you jumping in last second. Appreciate that. Yeah, thanks, guys. Thanks for listening.
Go to the room.